Have you ever looked at an earnings report and just wondered if the numbers were actually telling you the whole story? Well, spoiler alert, they rarely do. Welcome to This Explainer. Today, we're putting on our financial detective hats to look way past the surface-level numbers. We're going to learn exactly how to clean up accounting earnings to find the real underlying economic value of a firm.
Let's kick things off with a brilliant thought from Oscar Wilde. A cynic is one who knows the price of everything but the value of nothing. I love this because understanding the profound difference between the accounting price of a company and its true economic value is exactly what we're uncovering today. Look, anyone can pull a net income figure off a balance sheet. That's just the price. But discovering the actual value, that requires digging quite a bit deeper and adjusting for the literal illusions created by strict accounting rules.
So, here's our roadmap to finding that true value. We're looking at 1. The earnings illusion. 2. The R&D fix. 3. Uncovering hidden lease debt. 4. Normalizing the noise. And finally, 5. Calculating true value. Let's get right into it.
Section 1. The earnings illusion. Accounting versus reality.
We have to start by understanding this massive, fundamental, philosophical disconnect between accountants and financial analysts. They are essentially looking at the exact same business, but through two completely different lenses. The accounting view, it's strictly historical, bound by rigid rules and strict categorization. But the financial view is dynamic. It seeks the economic reality of future expected cash flows. Accountants want everything put in neat little boxes based on what happened in the past. Financial analysts, on the flip side, are laser-focused on what the firm is actually going to generate in the future. And this clash, it creates a massive distortion in how earnings are reported.
So, the crucial point here is that because accounting standards are just so inflexible, they frequently force companies to completely misclassify their true capital and financial expenses. This totally skews profitability. I mean, they force long-term capital investments right into the immediate operating expense bucket, and they disguise massive financial debts as simple operating leases. If we don't fix these misclassifications ourselves, our valuation of the company is going to be completely off.
All right, moving on to Section 2. Innovation as an asset, the R&D fix. Let's dive into our first major fix. This really completely changes our understanding of tech and pharma companies. Places where innovation is literally the lifeblood of the business. Imagine trying to value a massive pharmaceutical firm where its absolute biggest asset, its research, isn't even on the balance sheet. Crazy, right? But accounting rules demand that research and development be entirely written off as an operating expense the year it happens, just because the outcome is uncertain. But we know R&D creates long-term assets. So to fix this, we follow 3 steps. Step 1, accumulate past R&D to find the research asset. Step 2, amortize this asset over time. And Step 3, adjust the operating and net income by adding back the current R&D and subtracting that amortization.
By accumulating the unamortized portions of historical R&D using the calculation for the research asset, we suddenly create a tangible research asset. And this directly augments the book value of the firm's equity. So instead of a tech company's massive software investment just, vanishing from the books as an everyday expense, it's now rightly treated as a capital asset that is absolutely going to generate future cash flows.
Let's look at biotech giant Amgen to actually see this in practice. By adding back their current R&D, which, by the way, was a whopping $845 million, and then subtracting the amortization of their newly calculated research asset, their entire profitability profile completely transforms. We're literally moving R&D out of the operating expense column and treating it like the capital investment it truly is.
And here is the big reveal. When you correctly capitalize that R&D, Amgen's return on equity actually drops. It goes from a seemingly stellar 23.36% down to an adjusted 19.34%. So why does this matter? Well, because that unadjusted number was artificially inflated. By expensing R&D immediately, Amgen's book value of equity was significantly understated. Fixing this math gives us a much more grounded, realistic view of their actual returns.
Okay, Section 3. Uncovering hidden lease debt. Now that we've fixed the innovation illusion, it's time to uncover the hidden debts lurking just off the balance sheet. This is where things get really stealthy. I want you to ponder this mystery for a second. What if a company has 0 debt on its balance sheet, but is actually highly levered and at risk of default? It sounds impossible, but it happens all the time, particularly in the retail and airline industries. You look at a company's financials, you see 0 conventional debt, and you think, wow, what an incredibly safe business. But that could be a complete mirage. The answer to this mystery, it lies in the operating lease.
See, accounting rules historically treat these as simple operating expenses, kind of like paying your monthly electric bill. But financial reality dictates that a multi-year inescapable lease is a strict debt obligation. If you owe a landlord millions of dollars over the next 10 years and you literally cannot cancel that contract, you are in debt, regardless of what the accountants decide to call it.
To really make this tangible, imagine a professional sports team signing a superstar player, say Mario Lemieux, to a massive 10-year, $5 million a year contract without any performance contingencies. If they have to pay him no matter what, that is undeniably a fixed debt commitment, right? It's the exact same logic for a retailer signing a rigid 10-year lease on a storefront.
So to clean up the earnings, our math story goes a little something like this. We take all those future inescapable lease commitments and we discount them back to today using the firm's pre-tax cost of borrowing. This suddenly puts a massive new liability, a true debt value, right where it belongs on the balance sheet. And consequently, we have to adjust the operating income to remove the embedded interest expense of all those leases. Let's look at retail giant The Gap. For them, this is a total game changer. They officially had zero interest-bearing debt, but they actually had over $4 billion in lease commitments for their stores. When we add back their lease expense of about $1.1 billion and subtract the depreciation on the leased assets, wow, we dramatically boost their true operating income from roughly $1.9 billion to nearly $2.5 billion. The firm looks completely different once you uncover that hidden debt structure.
Which brings us to Section 4, normalizing the noise, shocks and one-time charges.
We have adjusted for R&D, we've tackled leases, but to find the true earnings engine of a firm, we absolutely must smooth out the temporary shocks. The market loves to panic over one bad quarter, but as focused analysts, we need to look at the normalized, long-term trend. For cyclical firms or those dealing with temporary crises, we use a few specific normalization techniques. We aren't trying to ignore bad news here. We're just trying to figure out what the firm earns in a normal year. We can average historical dollar earnings over a 5 to 10 year cycle, we can apply historical profit margins to current revenues, or we can just strip out massive one-time write-offs entirely, like a failed acquisition.
For example, look at Daimler-Benz back in 1995. They reported a devastating operating loss of over 2,000 million Deutschmarks. But when you actually dig into the numbers, a huge chunk of that loss was a massive one-time write-off for a failed investment in Fokker Aerospace. If we didn't strip out that isolated event, we would be making long-term valuation decisions about a car company based on a totally temporary accounting artifact related to airplanes. Normalizing the noise reveals the true operating health of the core business.
And finally, Section 5, calculating true value.
So, what is the ultimate goal here? Why go through all the effort of correcting managed earnings, capitalizing R&D, converting leases to debt, and normalizing shocks? Well, the vital takeaway is this. The raw numbers in an annual report are really just a starting point. By adjusting for R&D as a capital asset, forcing hidden operating leases onto the balance sheet as real debt, and smoothing out those temporary shocks, you tear down the accounting illusion entirely. You construct a valuation based purely on the real economic reality of the firm, not just accounting quirks. You move from being someone who just knows the price to someone who truly understands the value.
Which leaves us with this final thought for your next investment analysis. In a market totally obsessed with surface-level earnings reports, are you blindly investing based on the accountant's rigid illusion, or are you ready to dig in and find the firm's true financial reality? Thanks for joining me on this explainer, and keep asking the right questions.